And with that, I want to welcome everyone to 2021 Startup Investor Landscape. I've got some great investors here, and we're going to have a great discussion about what 2021 looks like and what are the changes, and maybe as entrepreneurs and startups, we can get ahead of some of these things when we're talking to investors in the new year. So let's make some introductions. Why don't we start with you, Stuart?
Hi, everyone. My name is Stuart Browne. I'm the CEO of Pycap Venture Partners, which is a venture capital firm based in Toronto. I'm also an instructor at the Scaleups School of Business, MBA, and their Master of Finance program. I teach a course called Venture Capital and Private Equity.
Great. And Allison, can you introduce yourself?
Yeah, of course. Hi, I'm Allison Weil. I'm an investor with Hyde Venture Partners. We are a Chicago-based seed to Series A fund that focuses on companies that are based in the middle of the continent, including the Greater Toronto area. Typically, seed through Series A, a lot in B2B software, marketplaces, and tech-enabled services. And yeah, excited to chat this evening.
Yeah, that's great, and we're great to have you as a newbie here at TorontoStarts. And Alex, go on and introduce yourself.
Yeah, I'm Alex Morsink, co-founder and managing director of Equivesto, a Canada-focused equity crowdfunding platform.
Allison, since you are the US VC here, should Canadian startups be reaching out to US VCs, or should they focus on getting funding closer to home? And if so, they're going to reach out. How do they start that initial conversation?
Yeah, I mean, I think the advice to Canadian companies is no different than the advice to any company, which is find a fund that is a good fit for the round you're raising and the type of company that you are. And if that is a, Canadian, crowdfunding platform like what Alex is working on, or if it's a, US based seed, Series A fund like where I work, reaching out is great. I'm personally a big fan of cold introductions. I don't see a reason why a lot of VCs require warm ones. And so, certainly welcome it. But you have to target the kind of investor which makes sense for you and your company, because that's going to be the kind of biggest thing. So for us, as I said, B2B SaaS, marketplaces, tech-enabled services, raising a round of 1 to, let's say, 7 or 8 million USD, growing extremely quickly, trying to 3x year over year. And so those are the kind of characteristics that we're looking for, and you can take a look at our portfolio. And so for us and other US based VCs, that's kind of the biggest thing. But particularly in Toronto, we're seeing a lot more US based investors get really active in the area, which I view as a great thing. And so, go ahead and do that with again, that what I'm going to kind of keep repeating of just effective targeting of the fund that's going to be the good fit for you and your company.
Stuart, Canadian VCs, and I've heard you say this yourself, are known to heavily favor software-based tech companies. Are we going to see any kind of shift in that, or in that needle? Are we moving a little bit more to manufacturing that we've seen a lot of COVID stuff, or med tech kick in, or is there something new coming, or are we still going to heavily favor software tech companies?
I think there is still going to be VCs favoring software and tech, and of course, med tech can be software for the medical industry, which is a huge focus and has been for a very long time, considering how vibrant Canada's healthcare industry is. But if I were to comment on a shift for Canadian investors, it's that Canadians want to invest in companies and take less risk as a result of all the craziness that's been happening in the market, in the economy. And what that means for the entrepreneur is that they'll favor companies that have more established business models and that are probably a little bit more later on in their life cycle stage. And so what the take-home message for entrepreneurs should be in that regards, I would say, is to focus a little bit more on establishing your business model, generating revenue if you can, before you go to a VC. because VCs, they don't want to put, or at least, I'm speaking about the Canadian VCs here, they don't want to put money into a company so that that company can figure out.
All right. Well, since he may or may not be connecting quickly, Alex, we might as well move on to the next one, and we'll reconnect with Stuart when he's back. SPACs, are all the rage these days. So I have, a couple of questions. We'll start with you, Alex. What is a SPAC, and why are they so popular with startups these days?
Yeah, so SPAC stands for a special purpose acquisition company. And so essentially, to sort of break down, the name kind of explains it. It's a company that's created specifically to purchase something, generally another company. And so SPACs are usually started and they do the sort of IPO process for startups backwards. So it's a company that's created and goes public with nothing. It's essentially the nickname is it's a blank check company because there's no actual company. It's just a holding company, and they usually have a mandate after going public and getting funded and selling the shares to then go purchase a company or a few companies within 1 or 2 years, or the money gets returned to the investors and it gets shut down. And during that sort of interim period, the money is held in an interest earning trust account, typically. So it's a little bit like if you think about the idea of a search fund doesn't involve going public, but it's still somebody going to investors, getting all their money first, and then going to find a business to buy. So for startups, if you're a small startup, SPAC is not anything that you really care about at the beginning. But if you are a larger, you're through Series B, Series C, you're at the point where you're considering IPOing. Being acquired by a SPAC saves you the time of having to go IPO yourself. It removes a lot of that additional oversight that you have to put on yourself as part of going to do the IPO, the $100,000 that you would then pay to the investment bank and everything like that. And it can sometimes help you get a slightly better valuation. But that's really, it's the focus for later stage companies. They were popular like 8 years ago, and then they kind of dropped off and no one really cared about them about 4 or 5 years ago. And now suddenly they're returning with a lot of popularity in 2019 and 2020. But I think the time that you would be looking at a SPAC and whether it's the right sort of fit for you would really be at the point where you're in the growth stage. I wouldn't necessarily call you a pure startup anymore. You're now sort of a startup in the growth stage. You've already raised probably from a VC or maybe even a private equity fund, and it's those investors who are looking to exit, and so they would direct you to the SPAC.
Yeah, and that my follow-up question is for you, Allison. How do VCs look at SPACs? Are they good? Are they bad? Or is it just another exit opportunity?
Yeah, I think it's the latter. They're just kind of another exit opportunity. If a company, like Alex was saying, right, these are for companies that we're already IPO candidates. We're already kind of have reached a pretty substantial scale and we're thinking about going public, and this is kind of a different way to do so. And I'll be honest, I'm not the expert on like why should a company SPAC versus IPO. It's just not something I know about. But from my perspective, any of our companies that are an IPO candidate or any of our companies would be a SPAC candidate would be a success in my view. And getting to that point would be an excellent problem to have and an excellent question to have to answer.
And Stuart, you were about to tell us what you look for, and then you cut off. We look for.
Yeah, sorry about that. For some reason, every time I start talking, it freezes and then it shuts down. Okay, we could try it again. Well, let me just also mention about SPACs. Like, if entrepreneurs are interested in that, of course, yeah, you're not at an early stage, but if you want to start moving in that direction, managing a company that's public is completely different than managing a private company. Like, your job as a CEO is different. Likely, you won't even be the CEO anymore because they'll have to bring somebody on board that has experience managing a public company. And not only that, but for those entrepreneurs that are thinking about going public one day, they're just like targeting the right VC and making sure you understand the motivations of why a VC would invest. You have to understand the motivations of why retail investors would invest in your company. And does that fit for the retail investor mentality? I would say that's almost a little bit similar to crowdfunding, for example. Like, if you're going to be reaching out to the crowd, there's got to be a connection there with the general public.
Or you have to be a very, very
like
good
freezing
marketer.
up again.
Well, we
Yes.
can hear you. We'll keep going. So
Okay, I'm gonna try turning my video off.
okay, great. We got a question from the crowd here. With COVID causing creative restructuring of business models, are investors and yourselves more open to startups providing wider platforms? Or are investors and yourselves looking for startups that are laser focused? So I guess it's whether their people are, for example, a supply chain platform focusing on coffee versus a platform serving supply chain in general.
So, good, interesting question. I think so. The thing that investors are looking for is a balance at all times of focus and market, right? And so you don't want to go too narrow with a company, because a supply chain platform focused on coffee, I have lots of questions about how large that kind of company can make. Just being, that might work, for the first little bit, but then you need to. My biggest question is going to be like, all right, what's the next industry, and then the next industry, and then the next industry that you're going to get to. And so, like, you've got a market size problem when you focus too narrowly. And so you want to build a software company. If you're talking about software, you want to build something that's entering a large enough market with an approach that means that the company can be large enough, but in a focused way. So it, like, a better example is on supply chain. Like, we have a company called Four Kites in our portfolio that focuses on supply chain transparency. And so it's not like the entirety of a supply chain, like of the supply chain. It takes a piece of the problem in the supply chain, but it's a problem that applies across every industry you could possibly imagine. And that's what enables them to grow large enough. That's kind of where how I think about it.
Sorry, any thoughts on that, Alex?
Yeah, I think Allison explained it very well. One thing that I would sort of add in, I think it also depends on the stage of the business, and a few other factors. Sort of building on your comments, Allison, where if you're coming in and you're trying to create your initial approach and your pre-revenue, you don't want to sort of come in and say our business is applicable in 150 industries when you don't have a single customer sort of or a full like sales cycle planned out, or you don't have a group of individuals who are going to want to use your product. You don't want to be so broad where you can say like, yep, I've created this device that everyone in the world is going to want to use it. So you don't have a well-defined customer. I think, at least certainly from my perspective, we're still looking for startups to say, okay, I've clearly defined who my customer is. I've clearly defined, how my product is actually going to go and solve a key pain point of these individuals. And then, given COVID, we want to know, okay, how could potentially you modify this or adjust this depending on how things go. We want to see that you can quickly react to changes in the environment and everything, and still drive forward your company to be successful. But it's not like all of a sudden we're looking for companies that are like, instead of me having 5, potential customers in this one segment, I've got one customer in 5 different segments. We still want to see that sort of focus on knowing who your customer is, knowing what their problem is, knowing how you're going to solve it, and making sure you do that really well.
And we have another question here that you've both kind of responded in the chat room. And you may or may not remember, but you talked to Michael last night, Alex. during our investor speed dating. It's him asking this question. Just so you
Oh,
know.
okay. His name doesn't appear for some reason when it says from.
Okay.
It just says from blank to all panelists and attendees on my thing.
Okay. We have been approached by a company which claims they can give us an IPO in 3 years. We are currently pre-revenue and through virtual mergers to accelerate and sell in 3 years. I've never heard of virtual mergers before and was curious, what are the thoughts on the panel here?
Yeah. I mean, I think Alex and I both responded in the chat. That's roughly whatever that is, it doesn't sound right. I mean, it sounds like a scam. Honestly, it sounds like somebody who is trying to rip you off out of some amount of money. Yeah, don't do whatever that is, because I've never heard of anything like it. And again, and what I also said in the chat, the end result of investing and the end result of starting a company is not to IPO, is not to be a publicly traded IPO company. Like, there are lots of there's like penny stock IPO companies that like do nothing, whatever. Like that's not your goal. Your goal is to build a company that does something that's productive. And the end result of building one that's exceptionally large might be to IPO.
Right.
But that's the order of things. And anything that tells you to go around the order of things is giving you bad advice.
Yeah, it sounds like, I totally agree, Allison. It sounds like in that situation, the person is trying to obfuscate or hide the real value of your company, and then would spend a bunch of your money, which would go to the development of your product or the expansion of sales, and instead spend that on legal and investment banking fees in order to force through an IPO on probably a non-popular exchange or a minor exchange. And then as soon as that happens and there is float at whatever the price is, they would immediately do what's called a pump and dump. So they would try to drive a lot of interest. At the height of the price, they would sell whatever ownership they had, and then they would leave you holding the bag, where investors would start suing you, and the stock would be worth 1 cent or less. So that, I would run far away from that. There's what you want to do, exactly what Allison said. You want to build a great company. When the company is big enough and successful enough, one way you can give your investors liquidity is an IPO. But as a founder, going to IPO doesn't even mean that you get your money out, right? Jeff Bezos still has 15% of Amazon. He's worth so much money, but he has no liquidity. He sold a few shares last year, and that was like a massive deal. And it's probably because he needed to pay off his house or something. As a founder, even after IPO, you essentially just hold your shares. You're not selling them, and you're probably just borrowing against your shares in order to live and have this sort of rich and fancy lifestyle that everyone dreams about. The founder is usually the first one in and the last one out. So even as a founder, running towards an IPO doesn't mean that suddenly is the big payday for the founder.
Yeah, you usually have to sell some shares when you go through a big profile divorce like he did. There's some few things you have to buy. New house, do this, do that. Stuart, entrepreneurs are generally afraid that they only get one chance at talking at a VC. This happened again at investor speed dating last night. So they wait and they wait. What advice would you give them?
I would say I would agree with that. Like, unless the VC is extremely interested in you, then yeah, you're only going to get one chance to present to them, and it is difficult to connect with them. And I'm surprised to hear Allison say that she's not against cold calls and what have you, because personally, and your fund is way bigger than mine. I get bombarded constantly. Like, constantly people are fighting for my attention. And it's not because I'm such an amazing person. It's because they want to raise money, or they want to leverage and be partners with us, or, who knows what it is. It's just, for whatever reason, VCs attract so much attention. And there's only so much of our attention we could give out. So I would say, yeah, you look at it like you only have one chance to impress a VC. And just like Allison was mentioning, make sure that you're pitching to the right VCs. You're not wasting your time or their time. And also, I mean, if I could just reiterate, make sure that it's the right timing for your company as well. Like if it's an idea stage and you want to see if somehow you're going to get lucky and a VC is going to invest in your company, it's just totally the wrong approach. Like build a good company, and then if you need financing, you can prove very succinctly to your investors that by them investing in your company, they're going to get a return right away, because maybe you have huge buyers lined up, or you have a purchase order that you can't fulfill unless you get some financing on board, or the company, your business is already successful in one region but you want to expand to another region, and you can prove why the investment in your business is going to create immediate value. Stuff like that is the right time to pitch venture capitalists.
And I would disagree a little bit, right? So we love meeting founders early on in their journey. And it's not to say that if I meet you early on and I don't like investing at the seed stage is investing in the person, right? It's investing in who are you and why should I bet on you? And so if I have an early call with you and you're great, but your business is a mess, then I will likely tell you, not right now, let's reconnect in 6 months or something like that, right? And so I like certainly don't take every call that I could take. It needs to come along. It usually should come along with like a coherent, like good pitch deck that like gets my attention, or a good hook to kind of get my attention. But there's plenty of founders that we've tracked over the course of a couple of years, multiple years, and haven't made an investment, and then all of a sudden their company kind of hits something. I mean, we just made 2 investments in companies that we had known for quite a while before making that investment, because the founders were great and we liked the idea. We just weren't. It just kind of wasn't there quite yet. Now, if you have that first call and like it's a bit of a mess, and there's like a bunch of problems with it, then I'm not going to take another call with you 6 months later, and I'm just going to tell you have a nice day, and like that really is your one shot. But I would say it's less about earliness for me and more about just like, who are you? Do you have your story together? Are you an interesting founder for this market? Is there a kernel of something that could work? Versus anything else.
I like the different approaches, and Stuart can be found at a lot of our events, at least when we were live, helping and speaking with entrepreneurs. He speaks and works and mentors entrepreneurs all the time. I just don't know at what point it gets overwhelming of people pitching him rather than just trying to ask for advice. So I don't know where that curve happens, right? So, Alex, what are the trends you are seeing in angel investments and alternative funding options? What should entrepreneurs be considering now to maximize their funding opportunities?
Yeah, well, obviously the creation of my company is an example of a new trend in funding. For a long time, you had to go the sort of standard bootstrap, friends and family, and then angel investment, and then VC, and then private equity, and then maybe IPO or get bought by a large other company. That was sort of the standard direction. And now, finally, there's a lot more options available for entrepreneurs, including equity crowdfunding, other types of crowdfunding, and even accessing government grants or other areas. And so it's not that every funding choice is the right one for every entrepreneur. There's whatever's right for your business isn't necessarily going to be right for someone else's business. But I would definitely recommend taking the time to understand the options that are available to you. A lot of businesses that can be very successful, but aren't necessarily something that's easy to sell or explain to the general public, won't necessarily do as well with something like equity crowdfunding. Then you'd need to go to a specialist VC like Allison or Stuart, who have a clear niche that they target, and they're happy to fund B2B companies who have a really great business model and a clear road to profitability. One thing that we appreciate about equity crowdfunding and the role that it can play sort of in the space is, if you look at VC investing, they're both professionals and they work for firms, and their job, they have investors themselves, and their job is to make sure their investors get good returns and they use that money effectively. That's a lot of pressure to pick the right kind of deals. And so they're going to make sure that they pick 100% the ones they really believe in, they think will be successful. With equity crowdfunding, because you're getting your whole community and the general public to get involved, and you're asking for so much less from each person, potentially as low as $100, it's possible to get more engagement and more involvement and actually more investment for businesses that aren't going to have that super aggressive road to profitability, 10x return in the next 5 years type thing. There's other great businesses that are going to have only 3x return or 6x return. And if they don't fit the type of business that works great for the VC model, you're maybe a bit closer to a small business as opposed to a startup. There are options like equity crowdfunding that can be useful. And there's a lot of angel investors who are sort of willing to play in both spaces. Traditionally, angel investing was for high net worth individuals who had $25, $50, $100,000 that they were willing to put down of their own money into a select number of companies. But with equity crowdfunding, because we're using technology to pool money and do the documents and everything, and that's a lot cheaper, it's possible now for angel investors to participate even at lower amounts, but still more than the general public. And so it gives a lot more range and flexibility for them as well. So I would just say to startups, definitely look at all the options that are available for you and try to find one that sort of fits what you're trying to create with your business. If your business is something that you want to scale aggressively and you can potentially find customers globally and you need to have that aggressive, rapid growth to hit that 10x return, maybe equity crowdfunding is not worth your time and you want to go chat with Stuart or Allison. But if you're building a business that has a lot of community buy-in and you want to reward and support that community, then maybe equity crowdfunding is a good choice.
Great, thank you. Allison, I had at one of our startup drinks events early this year, it might have been late last year, that's a little bit blur with, our last event was March, so they all blur together before that. We had the founder of Remine in, and they just raised $55 million. And they were chatting about how U.S. VC money changed things for them. And, he always heard about it, but now they're realizing it. So can you tell us what's the difference between U.S. VC versus Canadian VC, and how does U.S. investment change things for a Canadian startup?
Yeah, so there's kind of two core ways that it changes things. First is there's just more US VC money. I'm a $100 million fund. I'm a relatively small fund for the US ecosystem, but a pretty large fund for the Toronto ecosystem. Not the largest out there, but kind of there. And so one is there's just more money, and it gives you, once you have one US investor on board, it makes it a lot easier to get additional US investors on board, including, coastal investors who are going to fund much larger rounds than I would ever be able to fund. So that's kind of the first thing. The second thing it opens up is the US market itself. So, a requirement for me to invest in a Toronto-based company, any kind of Canadian company, is if you are not already operating inside the US, then you need to have a really clear and immediate pathway to getting there, because the market size is so much larger. And so it's a signal that you're doing that, and it's an opportunity that enables you to accelerate that US market growth, and potentially broader market growth. US venture investors probably do have a slightly higher risk tolerance. It's just they are looking for a little bit of different things, and so that's probably the other piece of it, with access to just other kinds of American-based capital. That's not to say that there aren't some incredible, Canadian VCs out there. We work with all of them, and love partnering with, a bunch of Canadian funds. But if you're raising a $55 million round there just aren't that many Canadian funds that are going to be able to do something like that. And you really do have to find a US-based fund for a round of that size. That's not the same as raising $1 million round, in which there are plenty of Canadian funds who would be excited to do so.
So I've got a question in the chat room related to this, but I'm going to ask this first and follow up. I tell entrepreneurs that if they're serious about getting funding, they should talk to 100 investors in 5 weeks. They don't usually like to hear that. So let me flip this script here and ask the question in a different way to you, Stuart, because you're bombarded. How many startups do you meet before you find one to make an investment? Is it 100 to 1, 500 to 1, 1,000 to 1?
Yeah, it's a good question. I mean, I'm just meeting startups on a pretty constant basis. So, yeah, I would say it could be in the 100 to 500 company range. But I just thought of something that I should kind of throw out there when it comes to financing. Like I mean, Allison nailed it. There's not a ton of VC money going around in Canada. I know there's such a laser focus of entrepreneurs on getting VC financing, and there's just such a small little window that we could even legally able to be investing in, like irrespective of if they're technology or software. So I just want to suggest that entrepreneurs kind of think out of the box and maybe go to some industry leaders within the industry that they're operating in and see if they could get some sort of corporate investment or angel investment, because that would offer like a huge strategic value. You might be able to resonate with the individuals more, and it allows you to kind of build relationships in the process as well. And in terms of meeting 100 investors within 5 weeks, just make sure that the investors are a fit. Once again, what Allison was saying, like you don't want to just take the shotgun approach. You want to take the sniper approach when you're pitching someone. I actually had for one of my classes, we had a dragon from Dragon's Den, Vince Guzzo, on, and he makes a lot of investments. Like he'll invest millions of dollars into startups. But he's very selective, and he does it in an interesting way. He doesn't do like the spray and pray approach. He invests in companies that he can integrate into the businesses that he owns. So he owns real estate, he owns entertainment. So he'll invest in companies that he could fit into these different segments of other companies that he owns. And then, of course, he's able to add so much strategic value and connections. And for him, it's not so much just about the exit, where with VCs, it's all about the exit. That's how we get a return. Selling companies from our portfolio, either via IPO or strategic acquisition. Whereas Vince, industry leader, he wants to integrate and build huge companies and generate tons of profit, and not necessarily exit, because he wants to have this massive empire that's very synergistic with the other companies that he owns. So I just want to kind of throw that out there to the entrepreneurs who might be a little bit discouraged at how challenging it is getting VC funding, that there are other opportunities that might even be smarter for them, given the circumstance.
Definitely a good advice. And the follow-up question here, and you kind of partially answered it, the question is about reaching out to VCs. And considering that, there's a different opinion that you don't want to reach out too early, save to the right time, should we focus on a few VCs based on our perceived synergies? And that answer to that sounds yes. But in the start, should they reach out to someone or particular on the VC team? So what they're asking, what happens behind the scenes, and they want you to pull back the curtain a little bit. Is the approach shared among VC principals, and from the outside, how does a startup know if a turn down from one VC principal is the official turn down from the VC itself? In other words, what are the risks of a startup simply reaching out to the wrong principal from a VC, and should the startup try one of the other ones after, etc.?
Yeah, I'm gonna say something unconventional, which is, and maybe I'm saying this because I'm not a partner at my fund, but I would actually advise you to reach out to the more junior folks on the fund. Because one, they're going to be a lot more likely to respond than the partner will. And so you'll be likely to get a call. What happens if you reach out is either I read it and I'm intrigued by what I see in the initial email contact, or, you know, the deck is interesting, your background's interesting, I might check your LinkedIn, whatever it is, in which case I will respond and set up a call for 30 minutes. Or I am not interested because of any number of different reasons. But I personally tend to reward cold outreach. And so, like, you know, that's where I'm at. And then I won't reach out. I might respond saying, sorry, not a fit right now, etc. You should not reach out to somebody else at my fund if I tell you no. And if I have a call with you and then say no, either on the call or shortly afterward, don't reach out to other people from the fund. They see all the notes. Like, we have a CRM system, just like, you know, any organization does. I take detailed notes in it. It's a small team. We all know and trust each other. And yeah, and the fund has an approach, and the fund, like, I know what each of the partners on my team are looking for. I know what I'm looking for. And if it's something that I think that it has a chance of us potentially investing, I'll move it along in the process and talk to folks. But don't reach out to other folks.
That's a great way to sour a potential future relationship with that same VC. So don't do that. There's a really great book called Venture Deals, which sort of explains the entire VC process for startups and sort of from the VC side. And that explains the labels of each role at the VC and sort of what they all do and everything. So rather than us just sort of trying to explain it all and take a bunch of time on the call, I would recommend reading that book. It's not very long. You can get it as an audiobook, I think for like $12 or something. It's a great book though. So Venture Deals, I would recommend you read that.
But definitely,
I'm just gonna. Oh, sorry. I was just gonna jump in, just add to the, you know, who should you contact. When I first started my career in venture capital and starting my own firm, I was fortunate enough to connect with like some of the rock stars in the industry, like the John Ruffalo, Kevin O'Leary, Bruce Croxon. Like, we're talking Canada, Allison. So they're probably not a big deal in the U.S., but for here they're a big deal. And what I noticed that often they're not actually the decision makers. They're more like the face of the fund, and they have the partnerships and the connections, and they're you know, they get so much focus around them, but they're not actually the ones who are making the final decisions. And it's people who you don't really see on the day-to-day basis, who are on TV and stuff like that. It's the more junior people who are actually doing the work and making the decisions at the end of the day. Just something to keep in mind.
Yeah, I was just going to say Venture Deals is by Brad Feld, and it's a book I recommend to every startup who is looking to get into it. And the audiobook is nice, but I think, you know, if you can get a physical copy or the digital book, because when you're talking about term sheets and you're talking about clauses, you want to kind of look at it and read it a couple times. So it's a great thing to have when you're looking at that. We've got time for just a couple of more. So I want to jump into Amit's question here about what do you look for in a founder when you're going to invest? Start with you, Allison.
Sure. So I look for a lot of different things. I look for a founder. The first thing I ask a founder, actually on every single initial call that I have, is like, who are you and how did you come to this problem and this solution? And I look for a good answer to that. And a good answer is often, I had this problem myself. And I needed a way to solve it. I've been working in this industry for X amount of years, and I realized that this hasn't been solved, and like it should be, and it's silly. It could be like those are kind of the two best answers, honestly, are like, you know, this is a problem I know really well, and I figured out a way to solve it. And you know, getting to that is the best thing. I look for founders who have had some success in their career, typically. And I guess this is giving away the profile of founder that I typically invest in is not 20 years old, college dropout. We are often investing in founders that are much older than that and have significant experience under their belt. But I look for success, prior career success, evidence that you know how to lead a team, evidence that you work hard and hustle and are like, there's a lot cushier jobs than starting a tech company. You got to really want it. And so I look for that too. And that's not a tangible thing. That's something that it's not a box that can just easily get checked. But lots of stuff like that.
Stuart, what do you look for in a founder? Oh.
I can answer for Stuart. I know him pretty well. He wants to make sure that you can bench at least 220. You're at least, 5'6".
That's exactly. You know what? You nailed it. That's it. Done. No. Okay. So, the thing that I'm worried about the most is as a founder who isn't in it for the long haul and isn't able to kind of power through. So, I mean, the best type of entrepreneur to invest in is someone who's kind of been there, done it, like a serial entrepreneur. And I'm going to say something that's going to sound very Canadian of me because Canadians are notoriously risk averse and they take forever to close a deal. For me, like, trust is a huge thing, and you can't earn someone's trust without putting the time in. So I like to get to know the people first and spend time with them and work through problems and stuff like that. And because it's a marriage that you're getting into when you're actually making an investment, and you want to be able to depend on the person. Because VCs, like, we have other people to answer to. Like, it's not just we're sitting on a pile of money and we could just, throw it at people at will, and we just do it whenever we want to. We have our own, like, limited partners that we have to go back to, and we're under the gun with our own investors. Like, we have to go back to our investors and say, why did we invest in this company? How is it performing? What's going on internally in this business? And we have to basically justify every single dollar we spend. So it's important for us to really make sure we invest in the right person. And for me, there's no substitute for time and getting to know someone and kind of building that relationship before you actually sign up for a deal with them.
Yeah, I think all of that is key. And I like to say that VCs want to know that when the going gets tough and you've been working 6 months, 100-hour weeks, and you can't pay your employees, and you're depressed, and your wife or your spouse or whoever it is bitching at you because you can't go out for dinner, are you going to get your ass off the couch and make things happen, or are you going to call it quits? And really, that's what you got to get across. And I that's kind of a crass way of putting it, but I think that's what I'm hearing from you guys. No?
No, you are. No, 100%. Yeah, you have to have someone who's like, for me, I'm glad you brought that up because that was something I wanted to mention, but forgot to. I'd like to see someone who was absolutely, like, completely obsessed with their business to a point where it's almost unhealthy. Like, but just, not completely unhealthy, but that's basically it. Who absolutely cannot accept failure with their company. Like, they will find a way to make it work regardless. And there are people out there, and I am very lucky to have some of my entrepreneurs in my portfolio that literally, I mean, it's difficult to get them to talk about anything other than their business, which is amazing because I just know they will never quit. Like, they are constantly pushing to make the company successful, and it's such an inspiring thing to work with entrepreneurs like that.
And I have one more question, and this is for you, Michael, in the chat room. We know that investors like traction. However, there are times when a startup needs to make some major investments before being able to launch. For example, building a cloud-based platform to meet regulatory requirements in a financial or security field. You may need to build and be audited. I know Alex kind of went through some of this, and I know Michael's going through some of this now. Before being allowed to proceed, what do entrepreneurs in this situation need to do to convince investors to take them seriously to invest at that stage?
Who are you asking?
Allison, we'll start with you. Yeah.
Sure. I mean, my answer is pretty brief, which is be a credible founder for that problem and product and solution. If you are Joe Schmo off the street who like has decided you want to do a thing and that's the situation, I'm never going to invest. And I'm really sorry to say that. But if you, as I said, have been working in this for 20 years and you're an executive and you have proven that you know what you're doing in this space, then I am more than happy to take a flyer on a pre-launch company that needs some serious R&D before going live.
And Stuart, what would your advice be?
Okay, so my advice is find traction in any way that you can. I disagree with the fact that you just cannot get any traction anywhere without having a product. Like we all know about the lean startup, or from the entrepreneur's perspective, picture yourself like you're a lawyer. Oh, geez, here we go again.
No, you're here. You're here. You're good.
You're back.
Oh, there? Okay, good.
Yeah.
Okay, so imagine you're a litigation lawyer and you're standing in front of the jury and the judge. Are you guys following me here? Can you hear me? Hello? Yep. Okay, good. You're building a case. Your case is that your company is a good investment and you'll get a good return on it. And your proof is your traction. So if you don't have revenue, you have to come up with some other proof. You need to de-risk your investment as much as possible and highlight the return potential. And the way that you downplay the risk is by showing evidence that your company has a good chance at being successful and it's not going to fail. And you do that through showing whatever traction you can. If it's a LOI from a customer, letter of intent, if it's beta users on your platform, if it's a survey that you're going out and getting 100 people to respond to. Anything that you can to prove that your company, there is demand out there in the market and you can deliver on that, will bring you closer to getting an investment than just saying, I have an idea or I'm in the process of building something and I can't do anything until you give me money, basically.
Great answer. And over to you, Alex. Knowing that you were in this situation, how did you get a significant amount of investment to build your platform before you were able to get traction?
Yeah. So it's quite similar to the things that Stuart and Allison have mentioned already, and a little bit different as well. So you definitely need to demonstrate traction as much as you can. You need to make sure that you have experience in the area and you're representing yourself as the right kind of person to go out and do this. And you need to find someone or some investors who are willing to really believe in you. And so if you have people that you know personally, then, and they're willing to give you money, that's the easiest route. But it's going to be harder to convince, people further out to believe in you. And this is where, raising from external investors can be really hard. And part of it comes down to how personable are you? And that's something that really sucks to hear, because not all founders are super personable and really great communicators and have great conversation skills and can get people to like them easily. And in those sort of situations, it becomes really challenging. And in that area, it sometimes comes down to, can you really convince those people in that limited amount of time that you have that you're trustworthy and you connect with them enough that they're willing to give you the money? And the reality of it is, it comes down to how personable you are.
And we have some follow-up notes there to everyone in the chat room from Michael, who was mentioning a situation there. Thank you for all that advice. Now we've gone slightly over time. Do you have any parting words for our audience, and where can people find out more? We'll start with you, Alex.
Yeah, I'd say, definitely keep working on what you're working on. And I'd like to chat with anyone who has questions about equity crowdfunding. You can check out Equivesto at equivesto.com or on any and all social medias at Equivesto.
Fantastic. And Stuart, any parting words, and where can people find out more?
Sure. Parting words is just, stay focused. We're in an extremely difficult time. There's a lot of problems out there, but good entrepreneurs are ones that create solutions for problems. And we've never been in a situation where there's been more problems than what we have right now. There's a light at the end of the tunnel with the vaccine. So keep your chin up on all of that fun stuff, stay positive, and just keep pushing forward. Like Alex, my VC firm, Pycap, is something I started on my own. So I'm also an entrepreneur, and we went through very difficult times, but we are on the other side of that struggle, and we are seeing massive benefits and living the dream, basically. I could not be happier. So if that's some inspiration for all of you, I hope you could take that and use it somehow. If you want to learn more about my firm, you can visit pycap.ca, pycap.ca, or you could send us an email at info@pycap.ca.
And Allison, parting words, and where can people find out more?
Absolutely. Find out more at hydeparkvp.com. Lots of information about that, our fund there. And parting words are, make sure you're doing something that you love. This is a hard road, and you have to have a real passion and excitement for what you're doing. And if you do, it makes the rest of it a lot easier.
Great advice. Thank you for taking the time to talk to our audience today. Thank you, everyone, for showing up, and have a great holiday. Thank you, everyone. See you in 2021.